Hi, I'm Kenny Roo. Welcome to Kangaroo Energy, where we share practical knowledge on energy, money, technology, innovation, and everyday life. We have something important today. Let's get into it.
Hi, I am from Kangaroo Energy. The government promised 1.2 million new homes by 2029 and said that would fix Australia's housing crisis. But what happens when the official projections don't line up with the promise? Today, we're going to unpack what's really happening behind the housing target, what recent economic projections are showing, and why this matters directly to your mortgage, your rent, and your future. Because if supply does not increase the way it was promised, the pressure doesn't disappear. It lands on everyday Australians. Let's start with the big headline, 1.2 million homes by 2029. On paper, that sounds ambitious. It sounds decisive. It sounds like a solution. But the real question is not what was announced. The real question is what is actually being delivered. Recent forecasts from housing advisory bodies suggest that completions may fall significantly short of that target. Instead of 1.2 million homes, projections indicate numbers closer to the high 900,000 range during the same period. That is not a small gap. That is hundreds of thousands of homes difference. And here's why that matters. Australia is already dealing with a structural housing shortage. Migration remains strong. Household formation continues. Rental vacancy rates are tight in many cities. When demand keeps rising and supply doesn't accelerate at the same pace, prices respond. That's not political. That's economics. Now let's talk about investment trends. For housing supply to increase, private and public investment in dwelling construction needs to grow. But economic projections have shown periods where dwelling investment is expected to soften rather than surge. If investment slows while population growth continues, the math becomes difficult. You cannot close a supply gap without sustained building momentum. Next, let's look at government housing programs. Large funds have been announced to support affordable housing and social housing initiatives. Billions of dollars have been allocated. The intention is to boost supply and improve affordability. But there's an important distinction between funding announcements and completed dwellings. When public funds are deployed, the key metrics to watch are how many new homes are actually being constructed, how quickly are they delivered, and are they adding net new supply to the market? If programs focus heavily on acquiring existing properties rather than accelerating new construction, the overall supply pressure may not ease as much as expected. Now let's shift to demand-side policies. One of the most discussed initiatives is the Low Deposit Home Guarantee Scheme, often referred to as the 5% deposit pathway for eligible buyers. On the surface, it helps first home buyers enter the market with less upfront capital. That sounds supportive. But here's the broader economic lens. When buyers can enter the market with higher loan-to-value ratios, demand can increase. If that demand enters a market where supply is constrained, price pressure can intensify. Higher loan-to-value loans also carry higher risk profiles. That doesn't mean they are bad. It means buyers need to understand the leverage they are taking on. If interest rates remain elevated or if economic conditions tighten, households with minimal equity buffers can feel that pressure more quickly. So we have three moving parts. A large housing target, projected supply falling short, demand-side assistance entering a constrained market. When you combine those elements, affordability becomes complex. Now let's bring this back to you. If housing targets are missed, renters may continue facing tight vacancy rates. If construction slows, competition for existing homes can intensify. If high-leverage borrowing increases, financial stress risk rises during economic shifts. This is not about panic, it is about clarity. There is no magic switch that instantly balances supply and demand. Housing is slow to respond. Planning approvals, land release, labor shortages, material costs, and financing conditions all play a role. The real solution to a structural housing shortage typically involves sustained construction incentives, streamlined approvals, infrastructure alignment, and stable investment conditions over many years. Not headlines, not single announcements, long-term coordination. So, what should you do? First, understand your risk position. If you are buying with a small deposit, calculate your repayment scenarios carefully. If you are renting, monitor local supply trends, not just national headlines. If you are investing, pay attention to construction pipelines and approval data, not just price charts. Housing markets move in cycles, but structural shortages don't disappear overnight. The key takeaway is this: targets are promises, projections are reality. Your financial decisions should be based on data, not slogans. At Kangaroo Energy, we break down complex economic issues into practical insights so you can make smarter decisions in energy, property, and finance. Because in the end, whether it's power bills or property markets, the numbers matter more than the noise. Subscribe for more videos, like, share, and stay informed.
Hi, I'm Kenny Roo. If this helped, Please like the video, subscribe to the channel, and comment what you'd like us to cover next.